Victors. Welcome to this week's Victory Show. This is Travis Cody. If this is your first time joining us, I'm the author of 16 best-selling books, and I've had the privilege of helping hundreds of business consultants, founders, entrepreneurs write and publish their own best-selling book as well. And in that journey, I discovered a fascinating pattern. A lot of businesses sort of hit revenue plateaus and they really struggle to break through those. So on this show, I sit down with some of the world's most successful CEOs, leaders, and business owners to uncover the strategies they use to overcome those plateaus and scale their business to new heights. So if you're looking to learn from the best and get actionable insights that can propel your business forward, you're in the right place. And of course, if you like this episode, please subscribe and turn on the notifications. Today, my guest is Peter Gudmundsson. He's the CEO of Be Home 24/7, a leading provider of unified property management platform technology for operators in hospitality and residential real estate. The SaaS property technology company allows property managers to control smart home devices, attain operational efficiency, and communicate with guests and residents. Throughout his career, Peter has led small and medium-sized businesses in the veterinary, media, human capital, and technology spaces. He's the author of 2 books. He's a regular media contributor and has published opinion pieces in Forbes, The Washington Post, U.S. News and World Report, The Hill, Christian Science Monitor, and many, many others. And he's also a former U.S. Marine Field Artillery officer. Peter is a graduate of Harvard Business School and Brown University. Peter, thank you so much for being here.
Thanks, Travis. It's my pleasure.
And first and foremost, thank you for your service.
Oh, it was a long time ago.
Yeah. Well, hey, we did it.
We won the Cold War.
There we go. So we were talking earlier and about a little bit about your background, and you made the comment about when it comes to businesses and scaling businesses, you prefer to come in and you're a buy, build, sell.
Exactly.
Guy. And you've gone in the startup space and have found that to be a little bit more challenging. So let's talk about that a little bit. I would love to talk about, from those 2 experiences, what have you found? Like, what are some of the significant differences between finding a business to buy and build versus somebody going out there and trying to bootstrap their own company as a founder?
Yeah, I think, in American business culture, we tend to overuse the term entrepreneur. I mean, everyone wants to call themselves an entrepreneur. I mean, there is a concept called entrepreneurship through acquisition, and that's essentially what I have done. But to me, 2 geeks in a garage, the proverbial Hewlett and Packard with a better idea, or Steve Jobs, that sort of thing.
Yeah.
I mean, that just takes a special person, someone who really doesn't care about, who just is almost oblivious to risk. The old saying that all progress relies on the unreasonable person. You almost need someone who just doesn't, like, I live in Dallas, Texas, and I often wonder when a new, Tex-Mex restaurant or a steakhouse opens, I think, what bravery it took. There are 3 more across the street. It's like Seattle does not need another coffee shop, and yet people keep doing it. And so you need a certain reckless regard. If you're at all measured and even, I would argue, grounded psychologically, it's just too hard. In many ways. But it's kind of like pursuing a career in music or acting. If it's your passion, you kind of have to do it. But if it's anything short of a passion, you will burn out. It won't work. And so I have found that I'm much better at systematizing something that's already starting, improving. Also, I have a psychological tendency just to what I would call humility, that I go in with a very much of an attitude to learn the business that I buy or invest in or get hired to run, because that way if you're humble, you listen. There's a saying a boss of mine told me many years ago, which is take the first period of time to figure out what they do right and then change what they do wrong. Some people do it the other way around. They come in guns blazing. I have a fancy MBA. I have all the answers. And that's a recipe for disaster.
Yeah, we just spoke with a business owner probably 3 or 4 episodes ago, and they bought a business when they were younger. And that was one of the big mistakes. They bought a very big business and then they came in and they changed everything. And then that first year was, it wasn't nearly as profitable as previous years.
Yeah, exactly. And very often the incumbent staff will sit back and say, well, okay, genius, you drive for a while. We'll just sit back here. And that's not good.
So how did your business journey start? Obviously you've got a fantastic education from Brown and Harvard.
And then military in between, which
Sure.
taught me a lot about leadership and how things run. Nothing about business, but a lot about organizations and people. And business school taught me about business, at least in theory. And I took a brief detour at the beginning on Wall Street as an investment banker at Morgan Stanley, which honestly I didn't like very much. But again, it did teach me some certain financial insights and financial discipline, how how to model companies, how to value companies, that sort of thing. There's a science to that. So the science of that matched with the sort of art of leadership that I learned in the Marine Corps was a great combination. And
Wow.
so really from there, I did some corporate, what we called in the mid 90s, sort of corporate private equity. I worked for KKR's media company, buying other media businesses. And that's where I really learned sort of the art and science of acquisition, which is what I call seller relations. It's a lot of salesmanship, frankly. It's contacting sellers and selling them on the idea of selling their business to you. In that case, I was working for a corporation. Later in my life, I did it for myself. And so it's a great education early in life, because acquisition analysis is really the whole totality of the business,
Wow.
really understanding how it works from start to finish. Very often it's a functional approach. How does marketing work? How does sales work? What's the product market fit? How does finance fit? How does accounting fit? All the operations, all these pieces come together in a holistic way. And that's what I really enjoy, is figuring that. So I'm a generalist by nature. So I like to know a little about a lot of things. Specialists are very different. And in fact, some people going through life, I have a son who's an orthopedic surgeon, have to name drop that. And he's the type of guy who loves being the guy who knows more about damaged knees than anybody else on earth. That would drive me crazy, but he'll help a lot of people that way. And so it's
Yeah.
a different way of looking at the world. So long-winded answer, but that's what I found about in my career. I've just really enjoyed that sort of diagnostic aspect of, what does a organization need to be successful.
So what were some of the big takeaways when you were doing analysis and starting to seriously look at companies to acquire them? Like what was really surprising about being from that, looking in at something of like, does
Yeah.
this make sense to buy or not?
Yeah, it's really combining what I call the heart and the head, meaning the intellectual and the emotional. So the intellectual is like I said earlier, the modeling, the understanding, the product market fit, size of market, total addressable market, as it's called, product market fit, the 4 Ps of marketing, all the basic sort of MBA 101 type stuff is what you just have to do. You have to work through it systematically. Who's the customer? What's the ideal customer? All these types of things. But then there's also a less I always forget which one's right brain and which one's left brain, but one of them is that intellectual part. The other is more of an emotional part, understanding the culture, both of the organization itself. It's almost anthropological. What drives this culture? If you walked into, I don't know, Walmart, they'd be talking about very different things than, say, Goldman Sachs, and different types of people with different values, different priorities, and I find all that fascinating. That's one of the reasons I've loved moving a different company every, say, 5 years, is that once I sell one, take a little time off, and then go find another one.
And you get bored and you got to go do it again.
Yeah, exactly. And it's just fun to crack that puzzle. And like I said, I think just starting with the humility of, I don't know anything yet, let me find out, and then apply what you do know from other things to see what patterns develop. But the key is to, again, have that humility, ask a lot of open-ended questions, and learn.
Well, so was there a particular size of business? Because I mean, you were in veterinary and you were media, you're human
Yeah.
capital and technology. So it sounds like it was more about the revenue versus the industry. Is that?
Yes. I mean, the industries you mentioned at the beginning are the ones that I've tended on. I've really liked information businesses in particular, including technology like software, but where there's content, where there's something to be articulated. For example, one of my companies about a little over 10 years ago was Recruit Military. And it was a for-profit company that helped other companies hire military veterans. And I loved it because one, it was just an interesting challenge. There was something like 15,000 veteran service organizations, nonprofits mostly, tried, and that started with the premise that, wouldn't it be nice to help veterans get jobs? I came in and very quickly determined that was not what we should be doing. We should be helping companies hire veterans, which is entirely different. I mean, it's not entirely different, but it's a different perspective.
Sure.
And it's really important because the logic was, all companies need great people. Most veterans are great people. Therefore, all companies need veterans. And that was fun, but I had to evangelize and articulate that. So I started writing a column for US News. I wrote an op-ed piece in the Washington Post, things like that, to articulate this. Look, don't hire a veteran out of pity or some sort of ill-defined patriotism. No, hire them because they're the best candidate for the job. And that's really what drove me. So anyway, I love businesses where there's mission-driven, maybe a little bit strong, but where there is a cause or a purpose that can be articulated through communication. I really enjoy that challenge.
Well, what a fantastic business on that one as well, because I've had my stints in the corporate world, and the middle manager is a cliche for a reason. You get promoted to the level of your incompetence, and if you can just take
Which I
people.
hate. That's called the Peter principle, which I've always objected to. What is wrong with my name? That same thing. Things peter out. They don't. I guess it could be worse. Could be called Jack or something. But it's anyway. I digress.
Take people that have had 4 to 6, 8 years in understanding organizational management and leadership, and put them in the middle, and it sounds like you'd solve a lot of problems.
That's fun.
Take me through the steps of when you come in and you're like, okay, this is going to be a good acquisition, again, with the idea that, because most people are like, I'm just going to build this company and be successful and live the life of an entrepreneur, and you're like, I'm going to buy something that's okay, and we're going to build it specifically to sell.
Yeah.
So when you come in, what are some of the steps that you take?
Well, even before coming in is when it starts. And so you start with the premise. You get a lead for an acquisition, whether it comes through a business broker or an investment banker, or you find it on your own through networking. So that's step number one. Then you start with a thesis. What could we do with this business? Is this a turnaround? Is this a reposition? Is it a just don't screw it up and let it keep growing? There are different approaches. And you start with a thesis, which you may modify and probably will modify once, as von Clausewitz said, no plan survives contact with the enemy. But once you get into it, but you start with that thesis, you work through that with your investor group, with your lenders, if there are any, and you start with that premise, and you have to have some sort of, 5-year projection and all this sort of stuff, which is most assuredly wrong, but it's a starting point. And then you go in there, and I always make a point, since most of my companies have been, fewer than 100 employees, and I meet with every single one. I spend an hour with every single one. And I start with a questionnaire that I'm filling out. They don't fill out, but I ask them essentially, what works here? What doesn't work here? What would you change? What would you not change? What's the essential thing? What else do I need to know? What advice do you have for me? And it's amazing how the themes will evolve very quickly. And you'll see, okay, here are 3 or 4 things that we, by all means, we do not want to change. And here are 3 or 4 things we need to get to, and we're going to have to prioritize what order we do that in. So that's very much the case. So I'm, again, sort of a very much of a populist approach.
Sure.
To
most people, for most businesses, they're probably shocked. It's probably the first time in their lives that anyone's asked them their opinion of like what's working in the business.
Yeah, that's a great point. And in fact, I spread out those things over the first month or so, those meetings, because partly I want the gossip to percolate out, and I'm giving away my secrets. But that, hey, he actually seemed really interested. Go ahead when you go in there, and sometimes people come back, hey, can I have another 5 minutes because there's something I forgot to tell you, and that sort of thing. And so that's really helpful. But I think you get 90% of what you want there. Well, that's not true. You get about 75% of what you need there. The other 25% comes from outside the company. Go on a listening tour with customers. Hi, I'm new. I just got here. I'd love to learn. Again, same questions. What works? What doesn't? What can we improve? Where do you think the opportunities are? And again, most of the time they'll tell you.
Yeah. Isn't that fascinating? Like from a principal standpoint, it's so simple, and yet it's something that most organizations don't ever do.
Right.
And it comes back to, we didn't chat about this before, but I was in Hollywood for nearly 20 years, and
wow.
Here's an industry spending billions of dollars, and you know what they don't ever do? They never ask what people want.
Right.
Which is so
fat. They want another Marvel movie. Isn't that what they want?
But as I always like that, my main mentor, that was one of his biggest things with he wrote a book, and the subtitle of his book was like How to Fix the Accidental Industry. He called it Hollywood Accidental.
Yeah.
And then he's like, well, here's how something works in the manufacturing space. And then he's like, and here's what they do in Hollywood. And it's a completely the opposite. And he's like, and then they complain when they lose $200 million.
Exactly. Yeah.
So I think that's one of the themes as I've been talking to people about growing and scaling, is like, so what are some of the primary things? And I think almost every single person has said, hey, you really need to understand what your customer actually wants.
Yes.
And
what business you're in? What is the product? What are you really solving for? There was after my time, but there was a now deceased Harvard Business School professor named Clayton Christensen, and his big thing is what problem are you solving? Is very, very important. So you may think, and one of his examples was that a milkshake is just a dessert or a drink. And it's like, no, it's a time killer. It's a thing people take on a road, on a drive, to make a drive a little more palatable, because they can enjoy their milkshake for the 1 hour that they're driving, which is kind of interesting.
And sort of the famous thing with McDonald's and Ray Kroc. He said the thing that shifted him was when he realized he wasn't in the hamburger business; he was in the real estate business.
Yes, yeah, exactly. That's a great example. Well, yeah, great example. The McDonald's brothers that he bought it from didn't know.
Right. That. Yeah. So what? From a leadership perspective, then what makes for a good a good leader in running teams, and what are some of the two or three things you see that again were probably very common, but that would have the opposite effect?
Yeah, I mean, there are many terms for the philosophy I aspire to follow. Ultimately, it's servant leadership, it's sometimes called, but basically, it's what I learned in the military a long time ago, which is that it's just really very simple. Two things: take care of your people and accomplish your mission. If you can't do one without the other, or if you do one without the other, it's ultimately ineffective. But you really have to care about your people, take care of them, get the right ones in the right seats on the bus, as the proverb goes, and then accomplish your mission. You have to deliver your numbers, get to where you want to go. And it's really that simple, which of course, like anything simple, it can be more complex in the execution. But if those are the guiding stars, good things follow most of the time.
So when you were acquiring a business, knowing that you were going to scale, so obviously you had your 5-year plan, but like, did you have a process of being able to go into a business and knowing like, okay, once we find a good business and we know it's got a solid foundation, like, was there a series of sort of steps that you could take businesses through to actually get it to the point where you could then, because I think you were talking about, there's a phase one business, which is startup, and there's phase two, and then there's phase three. So what are those phases, and how do people move, or how do businesses move between those?
Yeah, usually the first one is establishing some kind of product market fit, and this is where most businesses fail are early on. They're offering Mongolian food in a traditional town that just can't get their head around it. When that might have worked very well in a hip neighborhood, the product market fit's not there. And by the way, I know nothing about restaurants.
Yeah, that's a good analogy, though. Yeah, everybody gets that one.
Yeah, and so really, and there's also a saying that is it, and this is very true in technology, is it a feature, a product, or a company? And that's important to know that distinction as well, because sometimes people forget that, and they start a software company, really something that's just a feature. It doesn't really deserve to live on its own.
Oh.
So that's an important insight as well. So getting the product market fit is really the one of the first big steps at the beginning, and then after that, then really by phase two, it's really and the first step, you can do a lot of things yourself. Again, I have not been successful as a startup person, but you can do a lot. You really want to keep your overhead low. I mean, some people go the venture capital route, but I have a saying that venture capitalists have the parenting skills of sea turtles. I mean, they should be avoided whenever possible. There are certain times where it applies, but basically it's a devil's bargain that's not worth it. But if you're bootstrapping, you're doing a lot of things yourself. In phase two, you have to start thinking about systems. There was a book that influenced me probably 15, 20 years ago now, called The E-Myth. I'm sure it's been published a few times. And E-Myth Revisited, I think, was the sequel. Same thing, just stated a different way. But that's the saying there that summarizes the whole book is work on your business, not in your business. So in phase one, you're working in the business. And phase two, you're systematizing. You've got SOPs, processes, all the while be aware of bureaucratic, or sclerotic bureaucracy is not something you want at any phase, but that has to be purged from time to time. But thinking in a systematic way. What happens when the customer walks in? What happens next? What happens next? And that way you can actually also bring employees on more successfully and so on, because all those factors are very clear.
Well, it's interesting because I've worked with a lot of companies that they have a very clear, when you bring a customer on, here's what we do. But then when they hire somebody, they don't have that. So that's part of the systems, right? So if we're going to hire somebody, what's the
marketing is one tactical aspect of people management that most people fail at. It's amazing how many people, oh, there's your desk, let me know if you have any questions.
Good luck.
2 weeks later, they take them to lunch, and it's a little bit of a rah-rah, and they don't know what's going on. Onboarding is really important. Onboarding customers, onboarding employees, all those things are really, really important, and thinking that through systematically.
So when you come in, then you've got somebody they've got a good product to market fit. They've already started to build some small teams. So now you're there really optimizing systems for growth. Is it how big of how much of, trying to think of the right way to ask this, but how important are systems to be able to go from 2 to 3?
Yeah, absolutely critical. You can't do it without them. I mean, the system might be a very simple one, but it has to be clear and replicable. And we mentioned McDonald's earlier. Again, I don't know anything about restaurants, like I said, but I mean, the whole idea is you can go, the French fries are going to taste the same wherever you go. And that's not based on the cooking skill of the fry cook. It is the system they have in play, in that case, equipment as well. Even the franchisees can't decide, I want to add a little extra salt and see what happens. You can't do that. You have to follow the rules exactly. And that's an extreme where consistency of the product is the product in many ways. I'm sure if it's a 5-star restaurant that people enjoy a little variance here and there, and they trust the artistry of the chef at that level. But it really depends on the product, or the nature of the product or service that the company sells. But again, systems, I can't say enough about systems. Yet again, back to that heart and head, having the emotional intelligence to understand where the system is becoming the enemy, not the ally.
Awesome. So let's talk a little bit about what are some of the challenges that just come out of growth, right? So getting to 25 employees is 99% of companies will never get there. What are the sort of the specific challenges of hitting sort of that mark? And then how does things, especially as a leader, change in a corporation when you go from say 25 to 50 and then 50 to 100?
Well, I mean, in the Marine Corps, we were taught that the rule of threes, which is sometimes violated as rule of four, that one person can only effectively lead or manage 3 or 4 other people. You can lead bigger groups, but you have to do it through those 3 or 4 subordinates. And that may be a little bit rigid. You can probably do a little bit more in the civilian world, but to think in that terms is very important, because if you have 15 direct reports, you're not giving them the time of day, enough attention. They're going to feel like they're not getting the time of day. And so it's important to think a little bit hierarchical. Now, that hierarchy can be fluid and it can be pretty horizontal in many ways. But, where a lot of technology companies, especially in the Silicon Valley, we're all hip, we wear sweatshirts and have dogs in the office. And so there's no hierarchy here. Well, there has to be. I mean, even the Googles and Yahoos of the world or whatever all went through a phase where they realized that the hippie phase wasn't doing it. In many ways, it's just sort of can be window dressing. It's almost, I've been to a lot of technology companies where they have a foosball table in the corner covered by a sheet. And why is it there? Well, we feel like we had to have one because we're a software company. I'm like, no, you don't. But anyway, hierarchies can be spongy and they can be reactive. They should be reactive and all that. Information should flow up and down. It doesn't have to be General Motors 1955, but you do need some sort of structure. Who's responsible for what? What are the key metrics? Where does information, I have a piece of information, who needs to know it? Again, I would keep using the word systems, but those are systems, and systems operate within cultures. And cultures, and that's again, systems are the head and cultures are the heart, and those two are combined.
I've never heard it explained that way before. And that's great.
That's why I just made it up. But I think that's one way to.
That's the title for your next Washington Post.
Here you go.
Opinion piece. So then, for you being the owner of the business, how do you know that it's in time to start looking to exit?
Well, usually I've had investors, and so that also adds a certain.
And they get impatient and they're like, "Just go."
Well, sometimes that can be. In fact, that's investor selection is very important. Some people get so excited that someone wants to invest in their deal that they don't even really vet them, and what's their past behaviors been? Are they buy and hold people? Because if they're buy and hold and you say you want to cash out in 5 years, that may not be popular. Others may want to flip earlier because they have fund economics that they have to return money to their shareholders or investors and so on. So that's important. But a lot of it has to do with I'm a big believer in, like I said, I've tried to build a career hitting doubles and triples. And that's why startups are strikeouts, mostly strikeouts, and occasionally home runs. And I prefer doubles and triples. And that comes from that word humility, the humility to know you also want to sell a little early. You want to sell when there's still growth coming in, when there's a good story to tell, where the buyer can think, wow, they've come a long way. This is good momentum. I can take it further. Of course, there's always a little bit of hubris, the opposite of humility, in buying anything, because on some level you wouldn't buy it. By definition, you would rather own the company than the cash that's burning a hole in your pocket. So by definition, you think you can do more with the company. So as the buyer, you have to engender that message when you're the seller. Imagine what you can do with this company, and you sort of lay out the steps. Look, we've penetrated 40% of the market, and look how well we've done. Think how well you can do when you penetrate 80%, and you spell it out for them. And it's not a cynical thing; it really is a legitimate. But to get there, you're going to have to invest in this and this, and here's some of the risks and all that. Most buyers will appreciate that. And also, I should mention, it might be of interest to listeners, that I'm a big believer in flirting with the potential buyers really early. So almost at the point, like that Recruit Military Company, I was flirting with the potential sellers. I sold it 4 years later. I was flirting with the potential buyers of the business the month I bought it. And
Wow.
for subsequent 4 years, I sort of played them off against each other and played hard to get. It's not
Mhm.
quite the right time, this and that. And eventually it was the right time for one of them. I knew they were all private equity owned. I knew they all had fund pressures, and they had synergies with what we did. And so it's often good to, when you contact someone and say, hey, you want to buy my business? Already your price has dropped in half. So if
Wow.
it's you have to go through a few sessions of, nah, it's not the right time. I don't know. It'll have to be a pretty big number, that sort of thing.
So what was it that attracted you to the current company, Be Home
Yeah,
24/7?
it was just through networking here in Dallas, where I live. A friend of mine knew that a family office, actually out of Midland, Texas, had just bought a software company and they were looking for a CEO. I met them and we hit it off. The property technology space where we operated was very hot about 4 years ago when I joined. Still hot. It's cooled a little bit, but it's still a very hot sector. And so I like the people, I like the product. And then when I got to know the employees, I loved the company. So that's how I got here. And so I didn't really agonize over the decision. That's another thing. I sort of 80-20 rule. If it feels 80% right, give it a shot. And generally, if you just Hippocratic oath, first do no harm, and then do a few things right, good things usually follow.
That's great. So is the plan with this one to also grow and scale?
Yeah, definitely. Well, yeah, when I got here, we had about 1 million in revenue. It's a little smaller than I would have thought, recurring revenue, and we finished the year at a little over 5. And so the goal is to get to about 10, and then probably exit at that point. Again, to the point that it is difficult, especially in software. It's difficult. There's certain cut points of value. 5 million is one of them. 10 is another. Again, rule of thumbs. There are always exceptions. And then beyond that, everyone thinks they're going to be Google, and they're not. I mean, again, humility. That word comes
Sure.
back to says no. And also, you have to look at the marketplace. Like I said, flirt with buyers, but that also comes along from understanding that where is the fit? Thinking about not just you as an owner or a partial owner, but what's the best outcome for the asset itself? Where does it fit? Because synergies, people think of that as a spreadsheet thing, excuse me, at the high level, but it's really also about the employees, where their career is going to develop, and so on. There are a lot of factors that exit may be a good thing. Now, most employees panic a little bit when you say you're selling the company because they all have a neighbor or a friend who lost their job when the company was acquired, and they just assume that's what happens when people buy businesses. And you have to spend a lot of time articulating, why is this new company buying? You can't entirely vouch for them because you don't know how they're going to behave, but there's a reason they're buying this business, because it's a good business, and it's a good business because there's good people here, and you guys are good people, so you're going to be fine. If anything, at a small company, there's only so far you could grow in your careers. Now at a larger company, you've got more opportunity, and most people will get that.
Wow. So what advice would you give to somebody who's maybe at like late stage one, looking to possibly be like, oh, maybe they listen to this, go, well, maybe take this to a stage 2 and sell it to someone who wants to do it? What would be 2 or 3 pieces of advice you'd give that person?
Getting good advice, probably having outside advisors, whether it's your own board of directors or just sort of a committee of friends or acquaintances, or you mentioned mentorship before, a mentor, and just know yourself. Do you really, as you get larger, things get more abstract. Think about Fortune 500 company CEOs. They're almost like macroeconomic actors more than anything else. I mean, if you're the CEO of Ford Motor Company, you're not picking which leather to use in the Mustang. I mean, that's not your thing. At that point, you're looking at interest rates and cost of capital and whether to put your next factory in Mexico or Michigan, those types of things. It's very abstract the higher you get. And some people don't like that. I mean, if you're a car guy, maybe you want to have a local body shop and where you get to work on cars or work with the people who work on cars and smell the oil and the grease and all that. So knowing yourself, and likewise, what sort of returns do you want? Just like mutual fund, there's 3 types of gain usually. There's growth, value, and income. And what is it that you want to do? Value in the acquisition game sometimes is buying at a bargain price, because it's usually a turnaround, taking that risk, growing, and then selling. Growth is generally what technology is. You're banking on growing the top line, sometimes at the exclusion of the bottom line. And income is where you're clipping coupons, or you're really like an ATM machine. You're just regularly producing cash at a certain rate, which is where you'll get your return. So again, being very mindful, which game are you in? Which game are you playing? Sometimes it's a combination, but usually it's one of those 3.
Well, Love it. Well, Peter, this has been a fantastic conversation. If people want to learn more or be involved in what you're doing, should is like right now, like let's do the pitch for Be Home 24/7.
Yeah.
Who's a good user for that?
Yeah, so we serve two markets in real estate operations management, and that is the vacation rental or hospitality space and the residential space, which is single family rentals, multifamily or apartments, and student housing. And so anyone
Oh,
in those sectors should check us out at behome247.com. We say 24/7. I can be found personally on LinkedIn, and yeah, be a pleasure to help anybody who's looking to, what we say, drive efficiency in their real estate operations, deliver a better resident experience, and reduce risk of how they operate.
love it. Peter, thanks for your time.
My pleasure.